Welcome back. Retirement should be something you look forward to, not something that keeps you awake at night. But for far too many Aussies, knowing the best way to manage your super savings is as difficult as learning another language. And we also have the federal government eyeing off the super funds of many Aussie savers right now to bail out the budget. My next guest does a lot of work for you. Jeff Bresnahan is the founder of Super Ratings and has been teaching people how to be super savvy for more than a decade. Jeff, thanks for joining us on the program.
Cheers, Peter.
Now, before we talk about, thank God, some good returns on the super fund front, let's just quickly, because some people are a bit worried about the government chasing super funds.
Yep.
Why is there such a talk about attacking people with $1 million in their super?
Look, I think the attraction for every government, and it's going to be a more attractive target going forward, is that we've got $1.4 trillion in this system.
Yeah.
And, you know, it's just going to get bigger. We've got a compulsory environment where currently 9%, but that's moving to 12% by 2019. So just more money pouring into this system. Government's trying to find revenue streams. You know, particularly the federal government says, what can I grab? And it's a bit like a bear to a honeypot. You know, it's too tempting. They just can't leave it alone. And the issue for consumers is that every year super gets changed, they think it's incredibly complex. It's not, but because the government keeps tinkering with it, it creates a problem.
Especially, mate, when you add the volatile returns, well, let's just use the euphemism volatile, the crap returns we've had since GFC.
Yeah.
It's kind of like a kick in the guts. We just get a good super ratings, super return, and bang, the government wants to start dipping into it. It's kind of, it makes people want to actually think, is property and negative gearing a better way to go?
Yeah, it makes people stop and not activate strategies they probably should. The important thing for listeners, people watching the program, is the government's never done anything retrospectively on super. So they've always grandfathered things through. So if the law is a law, you'd have to expect that they're not going to change the law and suddenly say, this is the new law from tomorrow for everyone. It should be grandfathered through, and traditionally they've done that. So I think from a voting perspective, they're not going to take that risk.
Could lead to an avalanche of people over 55 taking that transition to retirement pensions.
Exactly. Yeah.
Are the tax concessions excessive?
Look, I think up until...
Careful, mate. A lot of people who go to your site are in super.
No. Look, the short answer is probably yes, but they're skewed the wrong way around. When Costello brought in tax-free pension phases in 2007, it was the wrong thing to do. It costs this country billions of dollars and will only get bigger and bigger as our demographic ages. So
what was the tax before then? Was it 15%?
Yeah, it was the same as accumulation phase. Yeah, and so basically by having tax-free in retirement, that's where all the big numbers are going to get to. So, and then they've compounded that error by saying, well, okay, we'll limit what you can put into superannuation. So that it's deterring people from contributing to super. You know, 25 grand maximum. It's very difficult for people to pay the mortgage off, bring up kids, and you suddenly wake up when you're 52 and you've done all that sort of stuff. Now I've got to fast track my super, I can't. So all of the concessions are skewed the wrong way. They should have much higher concessional contribution caps, or probably tax the pension phase as well.
Is it also a part of the problem that the economy is not growing fast enough and therefore the revenue is not there and then they go looking for a honeypot?
Absolutely. That's the whole issue.
That's why I wanted the Reserve Bank to cut interest rates to get the economy growing. Yeah. OK, mate, let's talk about the last return, because there's some good news for a change. The monthly returns for the 2012 calendar year, what were they like?
Yeah, isn't it amazing? In a year where we had all this negative news coming out of the US and negative news out of Southern Europe, you look at the monthly returns of super funds, which basically correlate with international and Australian equity markets, 11 out of the 12 months positive returns. Put them all together, so by the end of May, super funds have grown by about 3.7%. In that, between June and December, they spurted by another 8% to give it 11.7 million.
And that's the chart there, I guess it shows that.
Yeah.
So 11.7% was that the average or the median return?
That was the median return. Now, look, it'd be nice if you could say everyone got that. Unfortunately, the worst performing balance, we're talking purely about balanced options here, which most of us are in. The worst performing balanced option was about 7%. The best performing was 15%. So there's a disparity there, 8%, in depending what fund you're in.
And I guess if you were in a 7% fund, they were probably too cautious, and the ones that got the higher returns were more exposed to the stock market?
Yeah, nearly all of returns come down to asset allocation. So you'll find that those with a higher exposure in obviously direct shares in both international and locally did better than those that are probably more heavily orientated towards unlisted assets, infrastructure, private equity, those sort of things, purely for last year. But flip that over, and a 10 years period, then the funds that have had more unlisted assets have done better.
Okay, so we've had a good year, we've had some pretty ordinary years along the way.
Yep.
What about the calendar year annual return over the past 10 years to December of last year?
Yeah. If you bring up that 10-year graph, it basically shows that the last 10 years we really only had one bad year. Unfortunately,
2008, because the year Lehman Brothers failed.
Yep. So unfortunately, that was an incredibly bad year. So it has dragged back all of the returns.
Yeah.
So the average super fund in 2008 lost 20%.
Right.
Prior to that,
have we made that 20% up?
Yeah, we have. We finally got through that in about September of last year.
Yep.
We finally went above the peak, and then, as we know, markets have rallied, and they're now substantially above that base that we had.
The red line there, Jeff. Why did you put that in there? 153,000.
That's if you'd invested in cash 10 years ago and left it in a cash investment in a super fund.
Yeah.
That's your comparative between had I invested in cash, I'd have 153 grand. Had I put it into a balanced option, I'd have 183 grand. And you'll see the only time that they're actually touched was back in December 08, which is the bottom of that market.
And let's not get too graphical here, but if we start with that red line meets the green line, and we draw a straight line up to 183, that's really what super funds do on a consistent basis, but unfortunately the market goes up and down like a gigolo, you know what.
Huge disparity, and unfortunately, if you go back to 2008, it was the year when you had a lot of people in and around retirement saying, this is all too scary, I'm going to jump to cash at the bottom.
Yeah.
So they've missed out on that rally, and you can tell people as much as you like. Unfortunately, it's can they sleep at night? They couldn't, so they had to transfer stuff to cash, and they've missed the rally.
And it really cheeses me off, because there have been some institutions, I think, who have really cashed in on people's fear, and they've missed down that run. They shouldn't have, because those super funds, basically our super funds are pretty safe, aren't they, Jeff? Yeah, look,
in the history of Australian super, I think we might have had 4 or 5 reasonable sized failures. But the important thing to remember is the mainstream super funds, not self-managed super funds, mainstream super funds are governed by APRA. Now, APRA has in place a restitution process where they levy all of the remaining super funds to recover the losses for funds that fail. So it's a very important point to note. So if you're considering going and setting up self-managed super funds, you've got no protection. If you're in a mainstream super fund, you have that APRA protection.
And I guess if people are really unhappy with their returns, they can go to your website and they can pretty work out what funds consistently have been good performers. Even though history is no guide, in the absence of anything else, I'd rather a fund that's had a good history of performing.
Yeah, absolutely. Look, don't worry about your one-year numbers. You can take a grain of salt, because asset allocation will determine that, and there'll be huge disparities. But do look at your 5-7 year numbers in particular. I think 10's probably a bit far, but 5 and 7 year numbers. The 5 year number's not looking very pretty at the moment. But the 7 year number's looking okay. But if your fund is consistently or significantly underneath the median, then you've got a problem. Okay,
and also one final question: can people easily work out the cost that they're paying at their fund versus others? Because that's an important issue as well. Critical. If I'm paying 0.5% somewhere else and, well, pay 1% and get 0.5% somewhere else over a long period of time, that can have a big impact on my super.
Yeah, critical. Unfortunately, the industry is not good at transparency. There is, on your statement, you should be able to find a dollar number. If it's more than 1% of your assets, you're probably paying too much.
Jeff, thanks for joining us on the program.
Cheers, Peter.
Jeff from superratings.com.au. After the break, corporate reporting season started. Let's just see what lies ahead with the wonderful Julia Lee.